We have a protocol around the economic calendar to make sure that we're avoiding poor market conditions and also remaining in respect to proper and consistent risk management. So there's only 3 steps and 3 rules to this. Makes it very simple, but it's extremely important to follow very strictly. And we're going to use this example here. This is a real economic calendar, which you'll see really on any given week. This is very common, and we're going to walk through this explaining the 3 different rules. The first thing you always want to draw your attention to is there high impact news within the current week that I'm trading? The 3 high impact news events are CPI, which you see here, FOMC press conference, and NFP. Those are the 3 that we look for. So this example has CPI on Tuesday. The one rule with this is avoid opening any trades prior to 8:30. That is when this volatility driver releases a high impact news event. We want to avoid trading before that event intraday. So on Tuesday, no opening trades before 8:30. That really leads into the second rule, which is no holding open trades through a high impact news release. So no opening trades before, but especially no holding any open trades through these high impact events. Volatility enters the market extremely quickly during these times. It's unpredictable. It's going to slip your stop loss. If you think you're protected, you're really not. So we want to avoid that at all costs. That's where the risk management comes in play. The third rule, which is looking at any other news event on the economic calendar, that's what we consider lower impact events. We want to just be aware of these. For example, 8:30 core PPI on Wednesday, 8:30 core retail sales on Thursday. Those are where there are lower impact events on these days, but we want to be aware of these times because 8:30 now becomes an additional volatility driver that can be paired with an entry. We can wait for it to get better context. So it's very worth understanding that these times are in the market on those days if we're looking for a potential trade, because it's going to be super helpful. That is the entire protocol. It's 3 rules, extremely simple, straightforward, and easy to follow, but it's equally as important as it is simple because of these things, especially when we're dealing with risk management around high impact events. You really want to be sure that you're aware of these events, doing this protocol before you enter the charts. And then the third rule with the being aware of other volatility drivers outside of high impact events. It's going to help you get better entries. It's going to help you build context and build narrative on the days that you're trading. The final thing I wanted to address here is before I used to avoid the day before high impact news events. A lot of people know me for that, and you may not be aware that now I do not avoid the day prior to high impact news. We've collected new data on this here on the left. This is using NQ as an indicator for this. 365 points is the average daily range of every single trading day over the past year brought together. 365 points from the high to the low of a daily candle. And then when we take the day before a high impact news event, the average is still 341. That's plenty of room for a potential expansion. And there is not that significant of a difference from any other trading day. So we're not really concerning it. There's no correlation there. So I have no reason to avoid the day prior to high impact news events. This is going to be a very quick lesson, but I want to address a common mistake that some people may make with the economic calendar, especially when we're focused on a specific protocol around it. Using this as an example, this is a real economic calendar, again, of a certain week that you may see in the future. Now, after all of those settings and filters that we've taken out on this economic calendar from the default, this is still a pretty heavy week for news events. We have basically every single day has a red folder event. There is high impact news here. There is high impact news here on Friday. 2 high impact events within the week. Each day is having something going on. So it's easy to make the assumption when you look at this that this week is only going to make large price moves. It's only going to make expansions. And we want to be really eager to put on a trade in a week like this. That is what we want to avoid. There are other factors and even more significant factors than the economic calendar for what will anticipate and bring expansions. That's what we're going to talk about later in the course when we think about framework and narrative. That's really where our focus is. When it comes to the economic calendar here, it's just like our protocol. We're trying to manage risk. We're trying to be aware of when volatility will enter the market and pairing it alongside of these other things that we'll talk about later. Just like we want to be avoiding thinking that an economic calendar with a lot of news events throughout the week is only going to bring expansions. When we see an economic calendar like this, obviously lacking much news, there's a low impact event only on Thursday. This here does not mean that the week is set in stone to not offer any expansions. It is just going to consolidate or range. This here, this is still going to offer potential expansions. It's just that the protocol is very simple. You only need to know that 8:30 on Thursday is going to bring volatility. There's no reason to be avoiding anything, no concern with risk management on the economic calendar. You would just be following the protocol, but not making an assumption that a week like this cannot expand. The price signature section, which you're starting here now, is focused on giving you foundational knowledge on price signatures, which you will see in the charts, which you need to know for the following lessons. So we're starting here with failure swings. There can be either failure swing highs or failure swing lows. A failure swing low is formed when we make an initial low in the market, marked by this red dot here, and then we trade really deep back into it, marked by this low on the gray dot, but not quite through it. So very deep back into a previous established low, but then trading back away from it. There's also failure swing highs. We have this initial high that's formed. We trade slightly away from it, really deep back into it, but not all the way through, creating that high here. This is the failure swing to this high, and this is creating a failure swing high and a failure swing low. When you have this formation here creating failure swings, the relevant swing which you want to put focus on is that initial low that was formed or that initial high, not the actual following failure swing that was formed to it. So this is where the focus goes, and that's where we would annotate it on the chart. This puts our focus to the extreme highs and lows of the market. That's what we consider relevant, especially when we're framing our trades, using it as a draw, all of which you'll understand more as we continue to move forward. The first thing you should do when you notice potential failure swings in the market is compare that same area on a correlated pair or inversely correlated pair if you were doing something like Forex. So this example here, let's say this is NQ and on the right is ES. You notice on NQ there is that initial high, the market trades deep back into that high but not quite through it. That is a failure swing. That's the signature that we're looking for. So at that moment we would classify that as a failure swing. But then we would go to the correlated pair over here and looking at that same point, yes, we have that initial high, but we didn't trade into it and then fall short. We actually traded through it at that same high. So this is creating a higher high where this is a lower high. That is a divergence and instead would be considered a protected swing, which would actually change our protocol around this area here. You could trade away from that point, which we'll get into in the next lesson. You'll understand what I mean by that. Then we look at the lows. We have that initial low formed and then a higher low trading deep back into it, but not quite through it. We look to the correlated pair and we see that exact same thing. These are true failure swings, which we look to trade into and can be used as a draw. It's important to do that because this can change what your approach should be in the market at that time. So that's the first thing you should always do. Think I see failure swings. I'm going to look at a correlated pair just to confirm that they're true. If they are, then that's the normal protocol around failure swings, which you'll understand more of soon. But also if it's not, then we're considering it a protected swing, and that would change what you're doing at that time. We just went through the first price signature, which are failure swings. That is an area in the market which we do not want to trade away from. Now we're going to talk about protected swings. These are areas that we do look to trade away from. That is the main differentiator between the two. And we're going to first talk about manipulations. Manipulations are going to occur at relevant highs or relevant lows. This example shows a relevant low in the market. As we keep going through this course, you're going to really understand what makes a swing relevant, but this is just a general concept for now. That's where we know it's going to take place. So we're looking at a relevant low in the market. This is where we could expect a manipulation to take place. Once the relevant high or low is identified in the market, a manipulation is going to be trading into that point and then almost immediately turning back away. So this example here shows a relevant low identified. We have that marked out. Price trades down into it and then turns back higher immediately. If it's a relevant high in the market, price will trade up into it and then drop right back down lower right after. That is a characteristic of a manipulation because as you'll learn, the way that we define relevant highs and lows, these swing points in the market, they are extremes of the highs and lows. There is nothing else beyond that point, and we do that for a reason because once price trades into it, if it doesn't react, that is a telling sign that there is not a valid manipulation taking place. So that's one characteristic we really want to be strict on. Once that manipulation takes place in the way that we look for it, the relevant low, running that out, immediately turning higher, the confirmation is a change in state of delivery. Now, what is that if you're not familiar? It's the opposing candles that are formed into the point of reversal, which are then closed through. So this is a bullish manipulation. That means we're looking at the series or single down close candles, which ran into that lowest low. That's the manipulation. We're going to draw out the opening price of the highest down close candle in that series. Once we close through that, that is a confirmation that this low does not need to be traded back to. This becomes the protected swing. If we're thinking about a bearish example on a manipulation, we have that relevant high marked out and identified, price trades up into it. That series or single up close candle, which trades up into that point, we're looking at the opening price of the lowest up close candle in that series. Once price trades below and closes below that level, that is a confirmation that the high where price manipulated does not need to be traded back to. After you get confirmation with a manipulation, which is obviously the change in state of delivery, like we just mentioned on the close of this candle here in this example, that would be your confirmation. The next thing you want to do is, where does my invalidation point get set? So what can the market do after my confirmation that would invalidate the manipulation? Because you want to have that really well defined. This really depends on the step of the model that you are in. When we're working with higher time frame framework, trying to establish a bias or confirm one, think hourly time frame or above. That's where we're going to be setting that invalidation point at the highest body to the lowest body, which ran into that relevant swing to form that manipulation. So this candle body high to this candle body low, draw out equilibrium of that point. That is your invalidation. Following the confirmation here, we look for the market to remain above that point because this is a bullish manipulation. We don't want to see it drop below here because that would be too deep of a run to say that it's respecting these opposing close candles. When observing a manipulation for an entry on these lower time frames, when you get that close, the confirmation is exactly the same as any other step in the model. This here is your confirmation. We're thinking about an entry. Your invalidation point does not go to equilibrium of the opposing close candles. It goes on the opposing swing point marked out by 2 here, which you can reference in the text of the course in this lesson. This is where your stop loss would go when you take an entry. We never want to have it internal. It's always going at that opposing swing point because on these lower time frames, the market can make that deeper run while still keeping you in that trade. And we want to avoid getting unnecessarily and prematurely stopped out of any trade. Referencing back to what I talked about earlier of the characteristics on a manipulation, this here would show a lack of urgency on the manipulation where you would expect it to take place. So you have that relevant swing marked out and identified in the market, price trades down into it. It does not immediately turn back higher and it instead starts to fade away. That is not a valid manipulation. You don't get your confirmation here and that would be considered invalid. While this logic remains consistent across all time frames, there are certain steps in the model which will apply this slightly differently because there are trade opportunities that come from failed manipulations. Pairing directly with what we just discussed about manipulations, the second type of protected swing is a divergence. That is a confluence to a manipulation, and they really do almost mean the same thing because to have a divergence, that means there has to be a manipulation on a correlated pair. Using this here as an example, we have that relevant swing identified just like we would as usual. One pair here makes that manipulation, trading back down into it and then immediately turning higher, while the correlated pair also has that relevant swing in the market, trades back towards that low, but not quite through it. It makes a higher low where the correlated pair makes a lower low. That is a divergence signature. One pair makes that lower low to this low, the other makes a higher low. That is what we're looking for, and it acts in confluence to the manipulation. That is just giving us added confidence that is actually taking place. When considering the confirmation piece of the pair that has a divergence, it slightly varies from the manipulation. So when we use the confirmation for a manipulation, we use that series of opposing candles that made the lowest low before returning higher. Of course, this is a bullish example, but for a divergence, since the other pair made the lower low at that same point, we're going to draw from this series of opposing candles that made the higher low. That is going to be where we mark that out, the highest down close candles in that particular series. Once we get that close, that is our confirmation on the pair that has the divergence. If we were thinking about this for a bearish example, one pair would make that manipulation through the relevant swing to the left, while the other would make a lower high to that same point. The confirmation piece would be that series of up close candles that made that lower high to the relevant swing to the left. We're looking at the lowest up close candle, drawing out that opening price. Once we close below that point, that is a confirmation of a bearish divergence on that pair. This is completely optional, but if you want an added layer of confirmation when a divergence is present, then you can look for a close to the opposing candles on both pairs, the one with a manipulation and also the one with a divergence. That's just done to ensure there's no concern with any difference in relative strength or weakness between the two pairs, as a divergence does imply. You've already gotten your first look at this from the previous lessons where we've talked about confirmations of manipulations and a divergence where we implement opposing closed candles, but here we're going to dive into it a little bit more. Opposing closed candles are what we're going to be using in the continuation after a reversal has already been established and confirmed. As long as the market is in a continuation, we expect that opposing closed candles, once closed through, remain respected. So if a bullish continuation once closed above, we expect that to support price. In a bearish continuation lower, closing below up closed candles, we expect that to resist price. As long as there is a draw that still remains open, this is the concept that we're looking to follow. And this is a signature that is exclusive to expansion markets. When we set the narrative and do all that work properly, this is a signature that we get, and you're rewarded with something that's so simple but very powerful and consistent. And we're going to use it for a lot of framing trades and also for our entries. As I just briefly went through, and something that you already understand from previous lessons, the same concept applies when we're looking at that confirmation piece for opposing closed candles in the continuation. We have a series here. So this is a bullish example, down closed candles in a series. The close above the highest down closed candle, that opening price, that close above here is the confirmation piece that this low should not be traded back to. If it's a single opposing closed candle, a down closed candle in this example, that close above the opening price is the confirmation. It's the same thing, bearish, flip it. For up closed candles, the opening price of the lowest up closed candle in that series. Closing below that is the confirmation. Here you may be asking yourself, what is generally considered a valid opposing closed candle in the continuation that I should be focused on? And there's one general rule to be following, and that's when you're looking at either a series or a single opposing closed candles, we're looking for a wider range and a larger candle body. So 1 and 3, these two examples, we have a series of down closed candles, large candle bodies, smaller wicks, offering a wider range. 3 has a large candle body and a wider range. But when we compare that to 2, which is considered invalid, even though we have that close above the opening price of this down closed candle, this is not something that we would consider a protected low in the continuation, because we have a large wick to either side, a very small candle body, and also a generally small ranged candle. That is not going to protect your stop loss in the continuation. We really want to see these bulky candle bodies and this larger range on the opposing candles, because we know that in expansions, the market is not going to make deep retracements back down or against the trend that it's currently in. It has urgency to go in one direction, and we have a larger range like that close through. It's unlikely the market is going to drop all the way back down and then continue again. That's really what you're looking for. When you have these smaller ranged, it doesn't work in the same way. Again, repeating the logic that we've already gone through when we're setting that invalidation point after getting the closes through, it is different depending on the step of the model that you are in. If you're using it for higher time frame framework, you're using equilibrium from the highest candle body to the lowest candle body, marking that out. We want to see price remain above it if bullish, below it if bearish. If we're looking at an entry on a lower time frame, once we get that close through here and here, the invalidation point is on the opposing swing point. That's where we're putting our stop loss. That is the true invalidation point when considering an entry. The Monday rule is an extremely simple concept. It only takes one sentence to understand, and that is we do not trade Mondays under the expansion model. We skip over that day completely and start our trading week on Tuesday. And this lesson here is just to explain the 3 reasons why. The first and most obvious reason is that when we collected data over the past 3 trading years of the average daily range, so that's from wick high to wick low of a daily candle, that's what we consider the average daily range. We took that for Monday through Friday, so a given trading week. This bold number here that you see below is the average daily range number. So Monday was 262, and we can say, okay, that's decent. But when we look at that in comparison to Tuesday, Wednesday, Thursday, and Friday, all above 300 points, and we took this from NQ, that's a significant jump. This is the only one that breaks below the average, by a decent amount, and it's worth noting here. And we also took a number, this lighter one above, smaller. That's from the open to the close, so the body of the candle. That was also significantly lower, so less likely to offer a trend day, less likely to offer a large range, and that's a red flag when we're trading the expansion model. We're focused on daily expansions. Monday, based on data, is the least likely to offer that. The second reason has to do with the economic calendar, and this graphic here is showing where high impact news events can land within any given week. So CPI can be on Tuesday, Wednesday, and Thursday. FOMC press conference is almost always on Wednesday, and NFP, non-farm payroll, is always on a Friday. The one thing you'll notice here is that Monday never has a high impact news event, and that can be a cause of concern for really two reasons. The first is that the market is always waiting in anticipation for something more significant after. So Monday is lacking news. If there's news on Tuesday or Wednesday or Thursday later in the week, the market could be holding in anticipation for that event. That is something that can be considered for why Monday is likely smaller range, and it does play into it when we look into the more specific numbers in the data. The second reason being is that a high impact news event like these three here, when they are released into the market, they bring narrative because the volatility and the move is so significant that it may tell you what the future direction is. It gives you a good form of bias. And when it's on a Monday, you never get that luxury. So there may be weeks where you have to wait these opening days, the bias is unclear. And then once that high impact news event hits the market, suddenly the rest of the week starts to make sense. It does something of significance that gives you good narrative and bias, and that is always lacking on a Monday. The third and final reason we are avoiding Monday is because it is the opening day of the week. Now, for myself and in the way this model is formed, the weekly range and the development of that weekly candle does mean a lot in terms of your bias. And when you're opening up a new week on Monday, you don't have anything to look back on within that current week. So what I like to do every time a new week opens, I am resetting my bias from the previous week, and whatever happens ongoing, I am now developing a new bias. And on a Monday, you have nothing to look back on. That day, we let Monday print, and then we look back on what it did, and that is giving us a better gauge on what we should do going forward, Tuesday through Friday. The second caution protocol is what we consider the expansion rule. This is a signature on the daily time frame where once you see it occur, we no longer anticipate the trend from the previous direction to continue in that same way. We think a new phase of price delivery will take place. And that means it's a time where we have to reestablish the previous bias to something new, and we're being more willing to let days print without us because we want to know what that new phase of price delivery will be. The way we define this expansion rule and when we consider ourselves in this caution protocol specifically is when we have 3 consecutive days of expansion in the same direction. On the left here is a bullish example when you have 3 consecutive up close expansion days. On the right is a bearish example, 3 consecutive down close expansion days. It is at that point on the close of this third day, whether bullish or bearish, we no longer expect that same previous trend to continue into the next day. That is where we are expecting the market to either pause or return back into the range in some capacity. That means we're looking to reestablish a bias here, and that's why I mentioned it being a caution protocol, because you can't simply just expect that continuation. You want to be more willing to sit back, allow that to develop some more, and then you can see what that next phase of price delivery should be. Really think of this as once you see the signature, the market is going to at least pause in the direction it was previously going. You're looking for something else to occur at that time. It's important to mention that this expansion rule on the daily time frame only works when you have 3 consecutive expansion daily candles. On the left here is a valid example. All 3 days are expansion days, and then you can see here on that 4th day, the market does not continue in that same previous direction. It pauses or returns back into the range. This is what we look for to consider it a valid expansion rule. Classifying an expansion candle is simply a visual cue that you will get used to. It's opening near the low, closing near the high, forming that clear candle body, and having a generally larger range than most candles around it. Because it's an expansion candle, we expect it to be larger range. And that's what makes this rule work. So 3 consecutive expansion days, that's where it's valid. But when we have something like this on the right where we consider it invalid, yes, there are 3 consecutive up close days, but not all 3 are expansion daily candles. The first here, we can say yes, it is. But when we look at 2 and 3, that is where this is considered invalid because they open near the low, small body, but does not close near the high. So it does not have that large expansion candle body. We take a look at 3. It has large wicks to both sides, closes near its open, small candle body. That is not an expansion day. You can see how on the 4th day, it doesn't respect the rule of pausing from that trend. It continues and has the ability to keep expanding beyond that point. One thing to note with this is even more significant when you see this occur intra-week. So if it was to occur in between Monday and Friday, those 3 consecutive expansion days, that's where you get really, really strict on this rule because you would expect that 4th day after to absolutely pause or return back into the range. While the market can develop into a neutral range at really any point, this ties into the last lesson where very commonly after a large range on the daily time frame, that expansion rule, the market ends up consolidating, finding yourself in a neutral range, which is this 3rd caution protocol. A neutral range is defined when 2 things occur. The first is when you have failure swings to both sides of the market. So failure swing highs above, failure swing lows below. Just like you understand from the price signature section, you can't trade away from failure swings. So when the market has that to both sides, it becomes completely neutral. The second is once you see those failure swings to both sides, once price reaches equilibrium of these 2 points, the lowest low to the highest high, that is when you are now in a neutral range protocol. Once price hits equilibrium here with failure swings to both sides, you now put your focus to the external high and external low, and that's where opportunity exists going forward. That previous graphic was an hourly perspective, but where you're most often going to first find this is on the daily time frame because that is your highest time frame to be starting on. You'll see that there are failure swings to both sides. When you can see that wick getting really deep back into previous day swings at the highs, at the lows, creating those failure swings. And an inside candle is another big one that really does indicate prices beginning that neutral range. And it's really worth it where you identify it on the daily, then you go and break it down to the hourly to confirm those failure swings. You already understand this from the price signature section, specifically with failure swings and divergences. But when you first identify that potential neutral range with failure swings to both sides, you want to compare it to a correlated pair to make sure they are true failure swings and not false failure swings. This would be an example where you identify the failure swings off the highs, failure swings off the lows, and it's reaching back towards equilibrium. This is a potential neutral range. But then when we compare it to a correlated pair, we can see that at that same high where we see failure swings, there's actually a protected high which could be traded away from. So this is actually a bearish biased market where we could trade into these true failure swing lows because we have a failure swing here and the same thing occurring at that same point on the correlated pair. If you go through this process and notice both sides of the market have true failure swings, then you move on with the neutral range protocol, which we'll talk about here. Just like I mentioned before, when the market is in a neutral range, we're focused on the extremes, the external highs, the external lows of that range, because that's where we anticipate opportunity to exist. And that's where the failure swings get run out. So we're waiting for one of those 2 points to be engaged and determining what to do going forward, depending on the reaction. Here is the first example, which is a classic one that most people understand and are familiar with, is when we have a manipulation of the external range to then target the opposing side. What you're going to see on the daily is that we run up into that external high or external low, and we wick that point on a daily candle. So trading up into it, manipulating, and then immediately turning back lower, closing back into the range. That is a daily signature that shows a manipulation. That would give us an initial bearish bias to draw back into the external low or the opposing side of that neutral range. We can refine this slightly on the hourly perspective if we are looking to trade the continuation day only. Here you would see a change in state of delivery. So where price opened up, traded higher into that external high, dropped lower, had that confirmation, the change in state of delivery, closing below that lowest up close candle, which drew into that high. That is the confirmation that this high does not need to be traded back to. And the following day, you would look for that continuation, that expansion candle to the opposing side of the range. This is the second scenario that we can have, is that when price reaches that external range, instead of running up into it and immediately dropping back in for a manipulation, we actually see price expand through that point, and on the daily time frame having a strong close through it, that is a sign of not a manipulation, but a continuation and a true breakout of that neutral range. Again, refining this to an hourly time frame, looking within this daily candle, which closed through the external side of this range, you can look to see if after closing above that external high, since this is a bullish example, look to see if an opposing close candle forms and then we close back through it. That is an added confluence that this is a true breakout taking place, and that just pairs alongside the narrative and understanding that we can trade this as a continuation to the upside, understanding that's a true breakout higher. One distinction to make between the two ways that the market can leave a neutral range, like we just discussed, is that in the first example, when it's a manipulation, that can be traded either on the following day when you have that previous day close, confirming that it's wicking that external high, closing back into the range, and you trade the continuation. But you can also trade that intraday on the same day it makes that manipulation and reverses. That all depends on the size of the wick at that time, and you will understand what I mean by that in a very soon upcoming lesson. But with this second example here, when the market breaks out of that neutral range, this is more heavily reliant on the daily candle close, this here, and it's more likely that you're going to be trading this the following day after you get confirmation that the daily candle closed aggressively outside of the range. Before getting into the next lesson on valid framework, which is the foundation of an actionable market, I want to talk about this look back period. If you go to your TradingView chart on the daily time frame, go to the current daily candle and drag back while holding shift until that line says 30 bars. This is the range of price action on these higher time frames, which we consider relevant for framework, narrative, and bias. Anything that falls outside of that 30 bar range, we do not consider relevant for those three things. The only thing you would be looking at outside of that look back period is for a draw or for some sort of objective to trade into. This here is done to make sure that you're focused on more short-term price action. This is intraday trading. You're holding trades for maybe a few hours and closing out before the end of the day. So we really want to be fluid in our daily bias. By doing this, it forces us into looking at price action in a way that allows for that. We don't want to be making long-term predictions, very high time frame ideas, because when you get caught offside on those long-term biases, you're going to be unable to readjust intraday or readjust intra-week. Those are things that we need to be doing in this model, and having this look back period, having that strict window is really going to help with that. This lesson on valid framework is one that's extremely important, but also one that you should spend a lot of time with. Watch this video multiple times, practice in your charts, because it's an extremely important skill that you're going to continue to build over time. But this lesson will give you the basis of knowledge that you need to start applying it in your trading. Valid framework starts on the higher time frames here on the daily. That's always where you want to begin. You open your charts, immediately go to the daily time frame. Other than that, we can refine it down if needed to the H4 or the H1. These are our other hourly time frames that we can use to get a more clear perspective on price if necessary. On these higher time frames, you're looking for areas in the market where potential trades exist, areas in the market to trade away from. That's really the basis of what we're doing here, and it starts with understanding what a relevant swing is. Each valid framework will include a relevant swing in one way or another, so it's important to understand what I'm about to show you here. This is the process that I would follow when I'm looking for relevant swings in the market. Let's take this day, for example. Forgetting about this candle here, let's say we are in this day here and we're looking for relevant swings. Where does opportunity exist in this market? And you always want to look left. And your understanding of failure swings is what's going to get you by in this, because we understand we're not worried about failure swings. We're worried about that highest high and that lowest low. So this is the logic that I'm going to use here. Looking left from this daily candle here, is this next low relevant? No, because it is just a failure swing to this next low over here. Same goes with this low. Is this low relevant? Would I mark that out? No, because it is just another failure swing to this low here. Now, when I get to this low, I'm calling it relevant because when I look left again, this is not a failure swing to another low on this daily time frame. This is where that separation piece comes into play. There's enough distance from this next low, and I keep trailing my eyes. Remember, this low is not relevant because it's a failure swing to this low. This low is not relevant because it's a failure swing to this low, and that is the lowest low. So this is the next relevant swing, and there's enough separation between the two where I can differentiate between them and keep them separate. This is one relevant low, and this is the next relevant low. This is where I would mark my attention, and I understand a trade opportunity exists here. This example here shows invalid separation between two potential relevant swings. Looking left, you can make the assumption that this is a relevant high that you can mark out and frame a potential trade off of. But when we manipulate that high on this candle here, this would not be valid to trade away from, because this high just becomes another failure swing to this high. This high is just another failure swing to this high. This is the true relevant swing because it's the highest high. It's not a failure swing to anything else to the left. That is where your understanding comes into play. If it's just another failure swing to another high to the left or another low to the left, it's not the relevant swing, and you need enough separation. So when that is ran out, it doesn't just become another failure swing. Now that you have that understanding, we can move on to another example. Starting at candle 1, this is where you'll be looking left, understanding, is there a potential opportunity? Where does that exist in the market? Looking left from candle 1, we would see that candle 3 is not a relevant swing because it is a failure swing to this high to the left. This high is a relevant extreme, so there's nothing to the left of it that would be considered another failure swing. So this is the highest high that I would be focused on. Something running that out, I could frame a reversal there or a potential breakout. I'm looking left for something as a relevant low. This low is not relevant because it's a failure swing to this low. This low is not relevant because it's a failure swing to this low. And this low, of course, is not relevant because it's just a failure swing to this low here. Now, when we get to this point, there is that separation piece that we come to again. There is a lot of separation to this next low where I can consider this the next relevant extreme of lows. That's where my focus would be, because the market would have to go to one of these 2 points before I have a trade opportunity, and I would look for reactions at those areas. There are 2 valid frameworks that we're always looking for, and the first here is a close proximity swing. This is when a new day is opening near that next relevant swing, where it only has to create a small opposing run or a small wick on that daily candle to make a run into it and then reverse and expand in the opposing direction. We understand that opportunity can exist here. If a daily profile would align, it acts in the way we want, that can offer a trade opportunity. Now, we do this and we concern the small wicks because expansion days open near the low and close at the high when bullish, and open near the high and close at the low when bearish. So they make very small opposing runs in that initial wick on the daily candle. That's the signature we look for in expansions. We're focused on trading daily expansions. So when it's a reversal, we want that small wick. That's why we're concerned about close proximity. This would be an example here where it dips down into that relevant swing low and then can expand to the upside. Now, you don't have to trade reversal days if you're not yet comfortable with it. You can always wait for that reversal to be confirmed, the daily candles to close, watch that reaction, and then just focus on the continuation day. The second type of valid framework is when there's already a confirmed protected swing in the market from a previous day, and you're simply trading the continuation away from that point. All you have to be concerned with is the opposing draw still valid, or am I still in respect to that expansion rule? So I'm trading into the opposing draw, but I'm also concerned with I can only trade 3 consecutive expansion days in a row, and that's all you have to be concerned with. And I just briefly mentioned an opposing draw, and this is extremely simple. It is ideal to be trading away from a protected swing and the opposing draw being failure swings. That's just by nature the easiest condition to trade into. There will be times where you're trading away from a protected swing and into an old protected swing. That can be done, but it's always ideal for the opposing draw to be failure swings like this here. Like I said, spend some time with this lesson, go through it multiple times. It may seem a bit overwhelming at first if it doesn't immediately click, but if you just think about what failure swings are, enough separation, you'll start to see the logic behind where these opportunities exist. And then after that, it's just your daily profile confirmation, which we're going to get to in the next section. The weekly range works directly in confluence with the previous lesson on valid framework, because once you identify potential valid framework in the market, we can also align that with a weekly range profile, which adds that added layer of narrative to understand what the market should do next. The first step of applying the weekly range is letting Monday go without us. We've already talked about that in the Monday rule. Reason being is because every new week we are reframing and resetting our bias. And as we let these opening days develop, especially Monday, that's giving us context of what a weekly range profile may be if offered. Now, when it comes to weekly profiles, there are 4 that you are likely already familiar with if you've seen weekly profiles before: classic expansion, midweek reversal, consolidation reversal, and Thursday counter. The one thing these all have in common is that they don't go beyond 3 consecutive expansion days in the same direction. This pairs directly with what I was talking about before with the expansion rule, and why it's even more significant when it occurs within a single week. Weekly profiles are just that. They are avoiding Monday, looking to align it, and then they all do not go beyond those 3 consecutive days of expansion in the same direction. You can see with a classic expansion week, if Monday is ranged or makes an opposing run, Tuesday, Wednesday, Thursday expands, Friday returns back into the range because of that rule. Monday, Tuesday ranged or making an opposing run, midweek reversal, expansion for 3 days, and that caps it off. If it's a consolidation reversal, it can expand for 2 days. A Thursday counter, if the market expands from Monday, Tuesday, Wednesday, Thursday, and Friday, we expect to either pause or return back into that range. That is weekly profiles. If you understand the expansion rule in the weekly range, you are trading weekly profiles. Now, there will be times where one of these 4 profiles does not align, and that can and will happen in certain weeks. When that does occur, that just means we're not focused on the weekly profile or the specific days of the week. We just put our focus on the valid framework for our trades. When trading continuation days, we look into the previous daily candle to set an invalidation point. And there's only 2 different ways you need to know how to do this. The first is when we look into the previous daily candle, when we expect the following to be a continuation, is when it has a large opposing wick and that closing price is near the open on that daily candle. This is an example on the left for a bullish example. There is a large lower wick, so it's larger than the rest of that candle body. And then we have a close near the open. That means I'm going to take the low of that wick to the high of that wick, draw that out, and then 50%, or what we consider equilibrium, is that invalidation point. So this following day, we don't want to see that lower wick go beyond 50% of the previous day's wick. Everything should occur above that level. We should get that intraday reversal above, and then we can trade that to the upside. The same goes for a bearish example. We have a large upper wick. We expect the following day to be a continuation to the downside. We have a close near that opening price. So I'm going to take the high of that wick to the low of that wick, draw that out. 50% or equilibrium of that wick is the invalidation point. On the open of this next daily candle, when we expect it to be a continuation, it should not go beyond equilibrium of the previous day wick. That's where that intraday reversal should take place, anywhere below that point. The second type, again, when we're already expecting that following day to be a continuation, if the previous daily candle was an expansion daily candle, so if you notice, there's not a large wick here, there's a small wick, a large candle body, a large range candle. It's that expansion candle, which we mentioned earlier in the course. That would be when you mark out the low to high of that previous day range, and we get equilibrium of that point. That means the following day, for this bullish example here, we would not want to see it go below that invalidation point or 50% of the previous day's range. The same thing goes when we look at a bearish example. We'd be expecting that continuation lower on the following day. We look into the previous day. It's a large candle body, an expansion daily candle to the downside. I'm going to take the high to low of that previous daily candle's range. Equilibrium or 50% is that invalidation point. So the following day, we don't want to see that wick being formed through that point. It should be formed below, and that would be where it's valid. After defining these 2 points on the daily candles, you have the option to refine it down on an hourly time frame. So this would be an example of the previous daily candle. We're expecting a continuation to the upside. The previous daily candle was an expansion, viewing this on an hourly time frame. We could refine that down looking above 50%, because again, on the daily candle, we want to see the market remain above that in the following day, expecting the continuation. If we're looking for opposing candles above that point, we could use that as a refined invalidation. Since this low should not be traded back to anyways, we have opposing candles above 50% of previous day's range. Then we can mark this out from the high of that body to the low of that body, marking that out. That would be your refined invalidation point. It's just like in the price signature section when you're using higher time frame framework for opposing closed candles, you would use 50% as your invalidation point. And while this example shows one where the previous day was an expansion candle, this applies in the same way if the previous day had a large opposing wick. And at this point, you may be asking yourself, why do we even do this? And the reason behind setting the invalidation points in this way is when we're already expecting that continuation in an expansion candle. Just like I mentioned earlier in this course, expansion days have small opposing wicks. Bullish expansion days open near the low, close to the highs. Bearish expansion daily candles open near the highs and close near the lows, and they don't make those deep opposing runs before expanding in the other direction. This invalidation point in this way demands that signature and forces it on the market. On either example, if the previous day was an expansion candle or had a large opposing wick, if from that day that you were expecting the continuation, from the opening price, if it dropped below and through that invalidation point, it is showing that it has a large opposing wick. It's not making that shallow run anymore. It's making a deep run below the daily open when you were expecting that continuation higher. Of course, this is a bullish example, but it shows that it's creating a large wick, and that is not favorable for an expansion, so we consider it an invalidation. This lesson on valid framework is one that's extremely important, but also one that you should spend a lot of time with. Watch this video multiple times, practice in your charts, because it's an extremely important skill that you're going to continue to build over time. But this lesson will give you the basis of knowledge that you need to start applying it in your trading. Valid framework starts on the higher time frames here on the daily. That's always where you want to begin. You open your charts, immediately go to the daily time frame. Other than that, we can refine it down if needed to the H4 or the H1. These are our other hourly time frames that we can use to get a more clear perspective on price if necessary. On these higher time frames, you're looking for areas in the market where potential trades exist, areas in the market to trade away from. That's really the basis of what we're doing here, and it starts with understanding what a relevant swing is. Each valid framework will include a relevant swing in one way or another, so it's important to understand what I'm about to show you here. This is the process that I would follow when I'm looking for relevant swings in the market. Let's take this day, for example. Forgetting about this candle here, let's say we are in this day here and we're looking for relevant swings. Where does opportunity exist in this market? And you always want to look left. And your understanding of failure swings is what's going to get you by in this, because we understand we're not worried about failure swings. We're worried about that highest high and that lowest low. So this is the logic that I'm going to use here. Looking left from this daily candle here, is this next low relevant? No, because it is just a failure swing to this next low over here. Same goes with this low. Is this low relevant? Would I mark that out? No, because it is just another failure swing to this low here. Now, when I get to this low, I'm calling it relevant because when I look left again, this is not a failure swing to another low on this daily time frame. This is where that separation piece comes into play. There's enough distance from this next low, and I keep trailing my eyes. Remember, this low is not relevant because it's a failure swing to this low. This low is not relevant because it's a failure swing to this low, and that is the lowest low. So this is the next relevant swing, and there's enough separation between the two where I can differentiate between them and keep them separate. This is one relevant low, and this is the next relevant low. This is where I would mark my attention, and I understand a trade opportunity exists here. This example here shows invalid separation between two potential relevant swings. Looking left, you can make the assumption that this is a relevant high that you can mark out and frame a potential trade off of. But when we manipulate that high on this candle here, this would not be valid to trade away from, because this high just becomes another failure swing to this high. This high is just another failure swing to this high. This is the true relevant swing because it's the highest high. It's not a failure swing to anything else to the left. That is where your understanding comes into play. If it's just another failure swing to another high to the left or another low to the left, it's not the relevant swing, and you need enough separation. So when that is ran out, it doesn't just become another failure swing. Now that you have that understanding, we can move on to another example Starting at candle 1, this is where you'll be looking left, understanding, is there a potential opportunity? Where does that exist in the market? Looking left from candle 1, we would see that candle 3 is not a relevant swing because it is a failure swing to this high to the left. This high is a relevant extreme. So there's nothing to the left of it that would be considered another failure swing. So this is the highest high that I would be focused on. Something running that out, I could frame a reversal there or a potential breakout. I'm looking left for something as a relevant low. This low is not relevant because it's a failure swing to this low. This low is not relevant because it's a failure swing to this low. And this low, of course, is not relevant because it's just a failure swing to this low here. Now, when we get to this point, there is that separation piece that we come to again. There is a lot of separation to this next low where I can consider this the next relevant extreme of lows. That's where my focus would be because the market would have to go to one of these 2 points before I have a trade opportunity, and I would look for reactions at those areas. There are 2 valid frameworks that we're always looking for, and the first here is a close proximity swing. This is when a new day is opening near that next relevant swing where it only has to create a small opposing run or a small wick on that daily candle to make a run into it and then reverse and expand in the opposing direction. We understand that opportunity can exist here. If a daily profile would align, it acts in the way we want, that can offer a trade opportunity. Now we do this and we concern the small wicks because expansion days open near the low and close at the high when bullish, and open near the high and close at the low when bearish. So they make very small opposing runs in that initial wick on the daily candle. That's the signature we look for in expansions. We're focused on trading daily expansions. So when it's a reversal, we want that small wick. That's why we're concerned about close proximity. This would be an example here where it dips down into that relevant swing low and then can expand to the upside. Now, you don't have to trade reversal days if you're not yet comfortable with it. You can always wait for that reversal to be confirmed, the daily candles to close, watch that reaction, and then just focus on the continuation day. The second type of valid framework is when there's already a confirmed protected swing in the market from a previous day, and you're simply trading the continuation away from that point. All you have to be concerned with is the opposing draw still valid, or am I still in respect to that expansion rule? So I'm trading into the opposing draw, but I'm also concerned with I can only trade 3 consecutive expansion days in a row, and that's all you have to be concerned with. And I just briefly mentioned an opposing draw, and this is extremely simple. It is ideal to be trading away from a protected swing and the opposing draw being failure swings. That's just by nature the easiest condition to trade into. There will be times where you're trading away from a protected swing and into an old protected swing. That can be done, but it's always ideal for the opposing draw to be failure swings like this here. Like I said, spend some time with this lesson, go through it multiple times. It may seem a bit overwhelming at first if it doesn't immediately click, but if you just think about what failure swings are, enough separation, you'll start to see the logic behind where these opportunities exist. And then after that, it's just your daily profile confirmation, which we're going to get to in the next section. The 7-hour time frame is used to simplify daily profiling into 3 separate candles. This lesson here will be more focused on sharing the logic and the numbers behind why this is done. If you're not interested in that and the data behind it, you can move on to the next lesson, which focuses on the actual process of daily profiling with the 7-hour chart. However, if you are interested, this is what we look for in the 7-hour time frame. We split it up between 3 candles, which is the 18 candle, the 1 o'clock candle, and the 8 o'clock candle. The 18 candle goes from 18 to just before 1 o'clock. This is what we consider the Asia session, or what most would consider the Asia session. This is really how we treat Monday in the weekly range. The 18 candle is that in the daily range, where we're pretty much just avoiding it. You can see that it's really low volatility, and we don't expect much to happen here, and you'll see why in the process that is important. The 1 o'clock candle, we have that first volatility driver of the day with London open at 3. This encapsulates 1 o'clock to just before 8 o'clock, what most would consider the London session. Volatility begins to pick up and we could see potential entries taking place here, but because the market is generally slower, we apply a higher time frame, which you'll see in the entry logic section. And of course, the 8 o'clock candle goes from 8 o'clock to 15 right at the close of the New York session. And this is what most would consider the New York session here. We really focus on the opening hours of this candle. You can see the volatility starting to spike because of 8:30 news, the 9:30 open, 10 o'clock news. It's all very saturated in those opening hours. This is where we can use a slightly lower time frame alignment because the market moves so quickly and a lot of our opportunity exists here. The first data point, which is considered important for the 7-hour time frame in daily profiling, is the percentage of time each individual 7-hour candle forms the reversal for that day. We use expansion daily candles, so we excluded any days that were ranged or did not classify as an expansion. Now here we're looking at a reversal as if it was a bullish expansion day, it would be the low of the day. If it was a bearish expansion day, it would be the high of the day. The 18 candle forms that reversal 40% of the time, the 1 o'clock candle 21% of the time, and the 8 o'clock candle 39% of the time. This is something that really is important to understand because we have a profile that classifies an 18 candle reversal, which most people may not trade because it's considered the Asia session and it's odd to see reversals occurring at that time. But we have a specific protocol, which you will see in the next lesson, that covers that reversal for 40% of the time. The rest is very standard London and New York reversals, taking up about 60% of the time. The next data point is the percentage that each 7-hour candle takes up in an average expansion day. So the 18 candle on average takes up about 17% of that daily range, the 1 o'clock candle about 24%, and then the 8 o'clock candle at 59%. That is a significant difference. And you can see from that first graph that you were looking at that the volatility changes quite drastically when you get to the New York session because of those volatility drivers. And this is a great showing that this is really where you want to be participating, or at least holding your trades through these hours, because this is taking up the majority on average of that daily expansion candle. The final data point, which I believe is also extremely important to understand, is the percentage of time that each 7-hour candle closes in the same direction as the daily candle close. So the 18 candle closes in the same direction as the daily 58% of the time, the 1 o'clock candle 62% of the time, and the 8 o'clock candle, again, we see that really big jump up here at 83% of the time. It closes in the same direction as that expansion daily candle close. Now, that is something that is an outlier when we look at the 18 candle and the 1 o'clock candle. Sure, they're slightly above 50%, which is great, but they're right around that neutral point where we see 83%. That's a big difference. And that shows the 8 o'clock candle is most likely to be the continuation, forming the body of that expansion daily candle. This year, if you've noticed a trend, the 8 o'clock candle is extremely important. It's where you want to be participating a lot of the times. It's where you want to be holding your trades, and just over time, based on data, it's going to be resulting in your best trades. This lesson, I'll talk about the actual process that you can follow to daily profile with the 7-hour chart. And as you can see in this visual here, there is a daily profile for each 7-hour candle to reverse. So the 18 candle reversal daily profile, the 1 o'clock candle reversal, and the 8 o'clock candle reversal. It's easy to say that on any given day, one of these 7-hour candles will make a reversal eventually, but the point is that certain things have to develop in a specific way in order for it to be an actual valid daily profile. Before breaking down each daily profile, there is a 4-step process that you can follow, which will naturally lead you into trading these daily profiles in the proper way. The first thing is avoiding the 18 candle. Just like I mentioned before, this is how we treat Monday in the weekly range. We treat the 18 candle in the daily range. We are letting it go, seeing what it does, and that tells us about how we should move forward. The next is if there is an 18 candle reversal, so say we're bullish on a day, it makes a low, we are not trading within the 1 o'clock candle. We're looking for that added confirmation. If there was an 18 candle high when we were bearish, as long as that is in place, we are not trading within the 1 o'clock candle. We're waiting for 8 o'clock to participate. The second is that this is very basic. If the previous candle did not form a reversal, then we're looking for the following one to do so. This example here, if the 18 candle didn't reverse, we're moving on to the next. The 1 o'clock candle didn't reverse, we're moving on to the next. The 8 o'clock candle forms a reversal. The next thing is that we're looking for that small opposing wick. We talked about this in the previous day lesson, setting that invalidation point. We're demanding a small wick That is what we're looking for in this daily profile. If you do each of those 4 things, you will be trading daily profiles in the correct way. Moving on to the specifics of each profile, this is the 18 candle reversal daily profile. Just like we talked about in the previous lesson, when we think about the data, this occurs 40% of the time in expansion days. This is a specific profile that has a protocol where we need to demand extra confirmation. So this is a bullish example. Think about it bearish, it would just be vice versa to everything that I'm saying. When there is an 18 candle low, when I am bullish, as long as that remains intact, I am not trading or participating within the 1 o'clock candle. I am waiting until 8 o'clock. Reason being is that when that low is in place, these are generally lower volatility hours, these 2 here. So I'm going to be waiting until 8 o'clock to see one thing that would confirm this profile. It's that the low formed in that 18 candle, the market has broken away from it, either in the 18 candle, the 1 o'clock, or both, far away enough in the direction of my bias that I no longer need to concern it to return back to that intraday low. It's already in that continuation. If I do see that signature, then right at that 8 o'clock candle open, I'm looking for that first continuation signature to take place. And that's where I would be putting my entry on, understanding that the market is far away enough from this low that I don't need to worry about it. The market's already in that continuation intraday, but I still have that draw open above for this 8 o'clock candle to expand and continue in that direction. We're doing this to make sure that we remain out of the way of a false 18 candle reversal. So while that low may stay intact, there is a possibility that in this 1 o'clock candle, it could range. It could then drop lower, make a reversal. These are things that we don't want to jump on side too fast because we want that added confirmation. It will change what we do in that 8 o'clock candle, and that's where we're putting our focus as long as that 18 candle low remains intact. The next daily profile is a 1 o'clock candle reversal. That's going to happen when the 18 candle opens up, either ranges or makes an opposing run to your bias. You want to see that shallow run. So ranging is great. Making a shallow opposing run is fine. We just don't want to see that large deviation from the opening price. So this here, the 18 candle ranges, the 1 o'clock candle runs out that low, makes a reversal. That means the 8 o'clock candle is a continuation. Moving on to the final daily profile, the 8 o'clock candle reversal. This is very similar to what I explained before with the 1 o'clock candle reversal, where I'm looking for these previous 7-hour candles to be either ranged or making shallow opposing runs from that daily open, making that small opposing wick. This here does just that, more ranged price action, making an opposing run here, and then the 8 o'clock candle makes that reversal to then expand in the direction of your bias. This here is an invalidation daily profile. That's when the 18 candle, the 1 o'clock candle, or both make a significant expansion in one direction. It doesn't matter if it's with your bias or against your bias, it acts as an invalidation. If it expands in the direction of your bias significantly, that means it took out all the objectives for the day and there's nothing for the 8 o'clock candle to continue or trade into. If it goes against your bias, it's creating that large opposing run from the daily open, and that's an invalidation of the day regardless. Once you have a daily profile aligned and confirmed, that's when we move on to the entry logic within either the 1 o'clock or the 8 o'clock candle, which the expansion model is focused on. Here we're focused on the continuation entry. So before even considering that, we want our initial reversal confirmation to take place. That is going to be in the form of a change in state of delivery, which you see in this graphic here. Above this is bullish, so a series of down close candle. We would take the opening price of that highest down close candle. The close above would be a confirmation. If it's a single down close candle, it's just that one opening price. If it's a bearish example, it's the lowest up close candle within that series, taking that opening price. Once the market closes below that, that's the confirmation. If it's a single up close candle, even simpler, it's the opening price of that candle. The close below is the confirmation. Now, depending on which 7-hour candle this occurs within, it will change our time frame alignment. If this occurs within the 1 o'clock candle, then we're using a 30-minute and a 15-minute time frame alignment, because like we talked about before, that is a time window where the market isn't moving as fast. If it's taking place within the 8 o'clock candle, then we're using a lower time frame alignment because the market moves slightly faster with all these volatility drivers, and sometimes you need a lower time frame. So we're going to use the 15-minute and the 5-minute. The general rule with this, and when we're looking for this signature, go top to bottom. Start on that higher time frame, see if it's being offered. If it is, you have no reason to drop lower. We're dropping lower when it's necessary and when it's needed. Once you have that initial reversal confirmation in place, you can start to look for these continuation entry signatures, and the time frame alignment applies in the exact same way. You would either be looking to enter within the 1 o'clock or the 8 o'clock candle on the 7-hour time frame. If it's within the 1 o'clock candle, it's a 30-minute or 15-minute time frame alignment for these signatures here. If it's within the 8 o'clock candle, it's either a 15-minute or a 5-minute time frame alignment. Just like you understand from the price signature section for the lesson on opposing candles, the main thing that we're looking for is a bulky candle body with a wider range, whether it's a single candle or a series. That is the basis of it, but we can pair it with several confluences that create a more probable entry signature. These confluences include running out a short-term swing in that continuation and then closing through the opposing candle, having a divergence at the opposing side and then closing through the opposing candle, occurring at a volatility driver, a session open, a news release, either creating the down close candles themselves or pushing price to close through down close candles. The last one being in respect to previous opposing close candles to then have that close again in the continuation. These are all signatures to look for in addition to that general rule of opposing candles having bulky candle bodies, having a wider range. You bring these all together and it's going to give you better entries on your trades. The one common thing here across all of these is that your stop loss is always going to go at that opposing swing point that forms on the other side of these opposing candles. While I mentioned those time frame alignments earlier with the 1 o'clock and the 8 o'clock candle, these here are some variable time frames that you can use to filter through, which are most often used to get a better view of a signature that you're already seeing on these standard time frames. For example, here, the 1 o'clock candle, you're almost always going to go top down 30-minute to 50-minute, but there will be times where the 1 hour gives you the best perspective, and that's when you can use it. However, you don't want to drop below the 15-minute minimum within that time window. A similar thing goes with this 8 o'clock candle, the 15-minute and 5-minute. That's where you want your main focus to go, going top down 15-minute to 5. But there will be times where a higher time frame will be offered, like the 30-minute. Take that when offered. Higher time frame is always better. But there will also be times where the 5-minute, you see a signature, you see it there, but you want a clear perspective. You can filter down to the 4-minute and 3-minute as an option, but never drop down below the 3-minute time frame. Now that you understand the initial reversal confirmation, the continuation signatures that you would be putting yourself on side with, and where to place your stop loss, it's important to mention how you would actually enter on these trades in terms of your orders. The way that I always do it when I see my entry signature offered, once we get that close through the opposing candles, that is your green light to put on a trade. I always take the market entry on the open of that next candle if the risk to reward is already in my favor for where I have to put my stop loss. So this example here, once we get that close, I'm taking a market order on the open of this next candle, putting my stop loss at this low, and then I'm looking for that move for the continuation. I do this because a retest of these opposing candles is not a requirement at all. The market can continue expanding in this direction. So this is a valid entry. I want to make sure that I'm getting myself on side, putting my stop loss at the right area. I'm willing to risk those few points to not put a bet on if it will return and retest, because I just want to get on side with that valid entry. There are two different ways to define risk when putting on an entry. There is fixed point risk and fixed dollar risk. Many people may be used to using a fixed point risk because it's very simple, but that's actually the incorrect way to do it. We're going to be focused on a fixed dollar risk, and here I'm going to be explaining why that's incorrect and why we avoid doing any type of fixed point risk on our trades. This example here is showing an entry being taken on these opposing closed candles once closed above. We're using a limit entry here just for the sake of this example to be more simple for what I'm trying to get across. The entry would be at the opposing closed candle, 1840, that would be the considered entry. And a fixed point risk, that means you would be taking an entry, and regardless of the scenario, regardless of the entry signature, the volatility of the market, you always take the same point risk. So 10 points, 20 points, 30, whatever it may be. This example here is showing a 20-point risk. So that would be what this would entail. You take your entry and then you have a fixed point risk at 20 points. That puts your stop loss at an invalid point. This is never where we would want to place our stop loss. You've already learned this from previous lessons that a stop loss on an entry goes at that opposing swing. So that's where we always are going to place it. That's why a fixed point risk doesn't work. It's not going to place your stop loss at the invalidation point that the market recognizes. We don't want to just be using point risk because it places our stop loss in areas where you're going to have scenarios that the market can trade through it, not to the true invalidation point, and then go right back in your favor. Instead, you want to be using a fixed dollar risk for your entries. Again, we're using limit orders to make this simpler to understand. Here on the left, this entry signature, opposing closed candles closed through, it's demanding a 40-point stop loss from where you take an entry to that opposing swing. That's the valid place you would put your stop loss. This here on the right, just by nature of the market, this signature here is only demanding a 30-point stop loss from the opening price of that highest down closed candle to the opposing swing point. Both completely valid. That's where you would be entering in this scenario on the entry signature. But because of the way the market printed, maybe there's a change in volatility, the actual point that's required on these entries varies. Instead, we want to be adjusting our contracts or the size of our position to adjust so we have the same dollar risk across all our trades, but our stop loss is always at the correct area. Both of these examples using NQ contracts, 3 contracts on NQ for a 40-point stop loss is $2,400 risk. And at the same side over here, even though it's a 30-point stop loss, we add 1 more contract to make it 4. That is also $2,400 risk. So you even it out and you have it consistent across all your trades. This lesson here is not recommending that you risk any specific amount on your own trades. That's all up to you and will be dependent on the risk management section later. But this is just to show you how you should be entering your trades and adjusting your contract or your position size based on a stop loss, making sure that your stop is always at the correct place at the true invalidation point.